All right. Good morning, everybody. We got CPI data today. It's the biggest thing that everybody's talking about. There's a couple of different ways to look at the numbers that are going to come out today. They are expected to come in hot. They're expected to be, um, these crazy numbers got everybody upset, but they are lower than the 12-month numbers. If you look at the set of numbers in the last 12 months, there are some higher numbers than this one. And so as we get this one and the next two or three numbers, those highest values are going to drop off. And so the average is going to drop significantly. Nobody's really talking about that, but that's the way averages work. You add up, since we're doing a yearly average, you add up, the last 12 numbers and then divide by 12, you get your yearly average. Well, we have higher numbers in this 12-month average than what we're going to be getting today. And over the next 2 or 3 months, those biggest values will drop away and the average CPI numbers are going to be down significantly after that, which does point to that, mid to late summer rally. Just saying. Next thing everybody's talking about is the 10-year. There has been some analysts, I think it was JP Morgan, that gave forward projections of maybe 3.25 to 3.5 for the benchmark on the 10-year yield. We'll just have to see about that. What we're looking at is FX Street. If you have not seen my morning briefings before, this is a free site that you can go to get the calendar of the day, and it provides a little bit of anticipated impact. The higher the expectation of significant impact on the market, the darker this little box will be. It's not always accurate because we don't always know what's going to rock the market. Sometimes some little weird survey that nobody cares about, suddenly everybody cares about, and it'll rock the market. So don't take this on blind faith and see that some report is going to come out and you think, well, it's showing little impact, it'll be fine. Not always. All right, so as we usually do, go to Thinkorswim. We want to look at the economic events here. If yours is cluttered like this and it's just got a bunch of stuff in it and you can't find anything, hit the show all, turn everything off, and then hit Econo Day event. That will bring up the events of the day. I like to bring that description over next to the clock so I can see what time they're scheduled to report. There is additional auctions today at 11 and 1. Don't say I didn't warn you. Those auctions are just insanely crazy at how much it impacts our market, especially since you never hear anybody talking about them. All right, today at 12:10, we do have a Fed speaker. This is the person who was nominated for the vice chair position at the Federal Reserve. I believe she's going to be talking about the runoff on the balance sheet, and that's been a real big deal lately. Right? It's been something that the market's really been focusing on, and I have every belief that this speaker today is going to be throwing fireworks. So absolutely be prepared for this one. I know this is a really cluttered chart. Just kind of give me a second. and just, let it in, absorb it slowly. It's the weekly expected move indicator on a daily time frame. And this is the range of our week. These lines were plotted last Friday, and price closes for the week in the S&P around 80% of the time, a little bit better, a little bit worse, but most of the time, around 80% of the time, it closes in this box by the end of the week. These measurements are based on the implied volatility on the options chain. It's a forward-looking tool instead of a backward-looking tool like everything else. And it gives us the square root of time measurement for how far the market should or could move with 70% standard deviation in the next week. I mean, we made that move yesterday. And then we got outside of the boundaries and came back inside. The reason I mention this is I use this for a trade signal, not necessarily in the futures, but I trade options based on this. When you see SPY and the QQQ and the NDX, things like that, hit the edge on a Monday or a Tuesday. If we hit the edge, I go the other direction. I didn't get this one. I wasn't at the office yesterday. I was out running around, so I didn't get to go long. Maybe we'll get a chance this morning. But the expectation is when we get to the edge that the market comes back inside again. The really cool thing about this study is you can go back and look at it each week, kind of asking the question, did we stay inside the box or did we leave the box? And if we did leave the box, did we come back inside by the end of the week? And markets become unstable. They start breaking their expected move. They start moving in exaggerated form and fashion. So when we do break the week, we close outside of it. One breach with close, it's not a real big deal. But if you start to see multiple breaches and multiple closes outside of the boundaries by the end of the week, it really starts to become a heads up. If you go back and look at pre-COVID, as we came into that new year from December into January and then into February, right before the crash, you'll see that we started to breach the expected move a lot more, and we were getting closes outside of the box right before everything went to hell. Yeah, yeah, you'd like it. So for today, you want to game this out, kind of asking the questions. What do we got on deck, right? What could we do? There's only three things the market can really do, right? It can stay within the boundaries that it has set here, its own Globe X. I find that very hard to believe that that's what it's going to do, but it could. We don't want to say the market can't do something. We are outside of yesterday's price action, so we had an inside day breakout. We built our own range in the Globex. We could just stay there, deflecting off of yesterday's close and heading back down and just maintaining this range. That would be thesis A, maintain the range. Theory number two is we get back inside of yesterday's range and we begin working our way back up towards yesterday's open. That would be the target, 44.50. It's not spot on perfect with yesterday's open, but it's close enough. It'll do. It also aligns us up with that 200 period moving average on the 15-minute, but I wouldn't let that interfere with what we're doing, right? Don't let the moving average distract you from what we're talking about. It's yesterday's open. We want to focus on yesterday's open. That's going to be the target to the upside. And a simple question, how far away is that from our current location? It's not even 1%, 0.90, 0.88, pretty close to a 1%. We got an ADR right now, 1.7. We're talking about making a 1% move from our current location after 12 hours have gone by. You got to remember, right? We've been burning daylight. So we don't want to assume at this point we could still make the 1.6% move on the day. We're flat, basically. We haven't done anything. And if 1.6 is our average, then, it took 22 hours in the day to get that average. 21 days, a full day. Well, it's morning. We've already burned half that time frame. Can we move that 1.6? Yes, absolutely we could. But it won't be subtle. And we've got economics on the table that very likely could stop that from happening. but we could move 1.6 to the upside. We can go ahead and game that out while we're at it. That would put us right about the Globex, this Globex pivot point at 44.80. So that's easy enough to focus on. We also have a point of control from yesterday. It's the untouched point of control. We carry that forward. Virgin point of control is another way of saying it. And we have another point of control at 4,500. No, Steve, it hasn't come out yet. And the way that you could check to see is, when is it expected to come out? Oh, at 8:30. Look at the calendar, buddy. So that's our upside move. What are we going to do if it goes the other direction? Since we're flat, we want to measure what a downward move would look like to get us just back down to the bottom. That would be 0.7. And then from that, we want to just put in at least another 0.3% for a 1% move. And that gets us down basically to around 43.70. Now, we don't want to just arbitrarily mark a 43.70 just because it's a 1% from our current location and call it good. We don't want to do it that way. We want to go in and validate and see what we can line up with that. Looking at the volume profile, there's nothing that we can use for that. We would be below the current profile. Bring it out to the higher time frame. And it puts us right into this previous price action from late February, early March. It's about all that there is. We were in that box for a while, but we don't want to just lean on that. That'll be our target to the downside, but I wouldn't, since there's nothing there, I wouldn't expect that to be any kind of pivot point or support or anything like that. Don't approach it from that point of view. It's just a distance or a target we're going to be aiming for. All right, for the Nasdaq, same thing. You can see we made the edge of the expected move yesterday, this morning, rallied back up inside the box. We do have a steep trend line. If we're going to be anticipating a trend line breakover, it would take a significant push to get the current price up to that line. I just don't see it. I want to measure it out. The ADR right now is 2.5%, and we're basically flat on the day. Everybody's waiting for the CPI numbers, right? It makes perfect sense. Notice the range is really muted compared to what we were looking at on the ES, right? On the ES, we had a much wider Globex range. So you can see we're just barely above the close, right? Makes sense since we're basically flat on the morning. And this Globex high, Globex low is very unlikely to be strong enough to be our range for the day. I would say, even though we never want to say what I'm about to say, because price can do whatever it wants. I find it really unlikely that we're going to stay in this range. I would say we can't stay in this range. We're not supposed to say that, right? We're not supposed to say price can't do that, because in theory it can do whatever it wants. But I find it really, really unlikely that we're going to stay inside that range, especially with the CPI numbers on deck. Notice the rejection was across one of the pivot points from yesterday. Now that pivot point doesn't belong to anything. It's not like it's the open, high, low, close, none of those. It's just an area of resistance. The price came up and bumped its head against the previous resistance area. You got to recognize, however, that we've been through that. And so there's no trapped traders or anything like that. We've been through the level. We took out all of the liquidity. If there's anything there, then it's more like a volume node, right? So we want to game it out just like on the S&P. If we were to get bullish today, what would that look like? 14,100 would be one of our areas we'd be focused on. And then the open of yesterday, 14,150, right around in there. It's not spot on perfect, but you can zoom in and catch the open. Now we want to ask the question, is that too far? Are we reaching for the stars here a little bit? Well, 14,100 is only a half of a percent, and 14,15, 14,16, that's a 1% move on the day. We've got a 2.5 ADR. We could easily hit yesterday's open distance-wise. You do have to remember, though, 12 hours are gone, right? So kind of keep that in mind. And then, game it out the other direction. What if we were to get bearish rather than bullish? Well, we'd get back down below that 50, which we're going to talk about that 50 here in a moment. We would get back below that 50 and break through our own current Globex low, and then proceed to that 2% move, which puts us right around 13,750. That would be a bearish move on the day. Now, what's up with that 50? So I use the 50. I've been using it for years. I put it on every chart. It doesn't matter what chart I'm on. A daily chart, weekly chart, a 1-hour chart, a 10-second chart. I've got that 50 up. When we get a 50 line cross, it's always significant. Now, it's true, you'll find when we're sideways, crossing back and forth above the 50, there's nothing to that, right? And you'll get false starts where we break across the 50 and everything looks like we're going to get that rally back up, and then it all just falls apart, right? So just because we cross the 50 on its own doesn't mean we'd want to run out there and buy it. But on any time frame, anywhere that you ever apply that 50, when you have price crossing back above it and holding above that 50, you are looking at a market that's trying to change sentiment. We were good, clean, strong, bearish sentiment, holding underneath it, tagging it, walking the line, walking it all the way down. We started to set equal lows. Now we're setting higher lows. We've got a full set. So we got higher high and higher low times 2. That's a full set. And we're back above the 50. And it looks like it even retested, although, it didn't actually hit it. It does look like we had a little bit of a muted Busby there. So we do have the makings or the beginnings of a reversal off of these lows. But no amount of technical analysis is going to deal with the CPI results this morning, right? So while we have a full set and we've crossed the 50, and this is textbook reversal at its finest, just remember that CPI doesn't give a damn. If we do look at the volume profile and focus on what's overhead, we've got 14,100 with a very large area of volume resistance. And we are significantly outside of the volume profile box. When we're out of the box, we expect to go back inside the box. It's as simple as that. We do want to check to see if there's any untouched volume profiles that we can carry forward, the point of controls. So you can see that yesterday's point of control, when we carry it forward, we have not yet hit it. That's one that you want to definitely keep our eye on. When we get there, we will absolutely expect to see a response or a reaction from the market. That's at 14,062. And you do want to kind of be specific on that one. We talk often about using a fat crayon to draw trend lines. This would be one of those times you want to use a very sharp pencil. It's all a mental game, but it sticks. Speaking of untouched volume point of controls, We also have last Friday. So we didn't get back to it. You want to keep carrying it forward because it's over our head, and we will eventually someday go back to the upside. And when we do, we're going to make contact with it, and it's very likely going to have a reaction in the market. That's at 14,400. We carry forward those point of controls because they are significant. All right, so we've gamed it out. Bring in the futures on the other indexes. Got the volatility index, the dollar, the bonds. Look at the bonds this morning, guys. Rocking and rolling to the upside. This is really important to keep your eye on this morning. Bonds have just been taking the beat down. This is the 10-year. Want to jump over and take a look at the 30-year. It's also making significant moves this morning, and it's not being followed up with the dollar, right? So it's also, we have a market rallying up off of the lows in the S&P and the Nasdaq, and we have a market rallying up off of the lows in the bonds. Wait, what did I just say? Stocks and bonds are moving in the same direction? Yep, that's what I'm saying. And when you look at it and say, well, it's not supposed to do that. Yeah, I know it's not supposed to do that, but maybe the market doesn't know it's not supposed to do that. Yeah. Either way it goes, this is unusual market activity. You want to be prepared for an unusual outcome with this market activity. Also, be aware that the VIX is breaking back down again after that new leg up that it did going into the close yesterday. So we are up we're down off the highs. The highs that were set is 25.5, and we're at 24.5. The big thing right now is just stocks and bonds moving in the same direction, and oil rallying really hard after the close yesterday, up 4.25% this morning. It is significant. For years, they've been saying energy no longer matters. Energy is not a big deal. It doesn't have enough weight to move the market. They're eating those words now. They've been eating those words for the last 2 months, and I don't think it's done yet. The hedge trade, I mean, the least we could say is it's up off of the lows after that double bottom from yesterday. So gold set the double bottom. It came up, but it's still setting lower highs, right? So we're still underneath that significant pivot point, the high of yesterday. Bitcoin also up off of its lows. So when it comes to the indexes today, I mean, seriously, guys, keep your eye on the bonds and the dollar. We don't want to see the dollar begin to mimic the VIX again, like we were getting yesterday. Those two started to correlate. And one thing that's really important to stress at the moment, a highly correlated market state is really dangerous. If it's 75, 80, 85%, it's not that bad. We start getting in the 90 plus, tighten your stops, maybe reduce your positions, begin looking at your portfolio, asking, do I really need to carry some of these positions that I'm holding? Have a real comfortable perspective on the amount of risk that you're holding. When I'm talking about a correlated market state, we're talking about the advancing versus the declining issues. Now, I use the Analyze tab, I find it very comfortable to use. You don't have to use that, though. You can literally just look up the advance versus decline. But if you go into the Visualize tab and you choose your index and you choose, say, the S&P, this is going to look at the S&P 100, and it's going to ask how many of those companies in the S&P 100 are advancing, how many are declining, and where's the money flow. If this thing gets above 90, start to get very, very concerned. Now, it doesn't have to be the S&P either. It could be the Nasdaq. You can load multiples of these, by the way. So you can go in and you can, put one on for the FANGs. Then you can put one on for the S&P and one for the Nasdaq. What I like to do is get them all loaded up and then make them really small. They don't take up very much chart space, and they pin so they don't fall behind your charts. That way, when you're using something like the 4 grid that I use, you can kind of tuck those over into the corner, and you've got a very clear understanding of what's going on with the money flow and how many issues you have. What's the market breadth? Right? Take something like that, just kind of tuck it into the corner somewhere out of the way. Now you're looking at the Nasdaq and you're looking at the market breadth in the Nasdaq. It's a really useful tool to keep track of what's going on in the market. Just be very concerned about a highly correlated market state. Anything above a 90 plus, get concerned. Right. At the same time, you start seeing something like that, the ES market on a 1 minute chart with a volume greater than 8,000 contracts per 1 minute, get concerned. Now, of course, at the open, that volume discussion is not something we want to worry about, right? In the first 15, 20, maybe even the first 30 minutes of the day, you're going to get a lot of volume per minute. We're talking about after the open, right? Past that initial spike and hoorah in the market. And that bonds aren't slowing down even a little bit. Just get you some then, little Freddy Krueger freak. That's the 10-year. We could go through the sectors, but there's a very high chance that everything is flat because everything is waiting on the CPI numbers. So looking at the sectors, gold, oil, natural gas, Bitcoin. If we look at what's down, marijuana, retail, silver, the devil's metals down this morning, but only down slightly, right? Remember, the benchmark for us is at least 0.5% in either direction. So seeing that it's down, closer to 0.25% is basically negligible. And considering the move we saw in Jets yesterday, it makes perfect sense that they're down this morning, right? Mean reversion, linear regression. But there's sectors that don't really fit into the S&P 11. Those 11 sectors, those legacy sectors, they really leave a lot to be desired when it comes to identifying opportunities, right? So we want to make our own sectors by putting names together that fit inside a particular industry, sub-industry. So if we were to go look at crypto, for an example, this crypto list came from Tastyworks. It's not like I just randomly picked names out of a hat and threw them in there. These are the weights that make up the crypto futures at Tasty. They're not crypto coin. They're companies heavily vested in blockchain and or heavily vested in a lot of coin. Riot, Nvidia, TSM, Mara. So we got a pretty good list of names that are doing good this morning, more than 1% to the upside in a lot of those. So crypto's looking good this morning. The electric vehicles list. What stands out to me is the old school legacy names like Ford and GM are not doing really good this morning. They're kind of squishy. Tesla's basically flat. And then we've got, some of the lesser competitive markets, XPEV, Lucid, Li Auto, NIO. NIO's got a really nice trendline breakover setting up this morning with an inside day breakout primed. Let's just jump over and take a look at that. All right, when you have a close like we had on Friday, and then we open gapped down like we did Monday and rally back up, this is a play that we've seen before. we're missing a little bit of information. We want to bring the volume in. IBD metrics say they want to see volume greater than yesterday, and they don't put a number on it. They just say we want to see greater volume than we had the day before. So check, we got greater volume than we had before. We also could go in and look at the sizzle while we're at it. That would be volume sizzle, not options sizzle. Not at this point. We don't even need to look at options yet. It's called stock sizzle on Thinkorswim. Stock sizzle is actually stock volume, 5-day average stock volume. 1.0 is flat. So if we see 1.2, then we are 20% above the 5-day average volume. So we didn't just have elevated volume yesterday on that gap down rally up. It wasn't just greater than the previous day. It was also greater than the 5-day average. So we had elevated volume on a rally back up. We got a trend line breakover primed. And if you go back and look when a market has a gapped down rally up like that off of the lows, say where it happened back here, same thing, right? Although it really gapped down a lot farther than this example. But either way, when you get a market that gapped down that far and then rallied back up, you oftentimes get a significant follow through as well, right? Same thing here where we gapped down but kept going lower. And the next day we gapped down but rallied back up. And then look at the next day, a significant move in the overnight hours where it just continued on. And so this is a good setup. It doesn't fit any of the setups that I've already made strategies for, just pointing it out. I'm going to have to do a video series on it. But that is a play that you definitely want to recognize when you have the opportunity for it. So now when we go into the pre-market and start taking a look at it, kind of asking that question, well, what do we have at the moment? We are outside of yesterday's price action. Well, we were. Looks like we're back inside of it at the moment. Right. So in the overnight hours, after having faded off of the highs yesterday, we rallied back up and we had an inside day breakout in the overnight hours. We want to see that stick. So let's go back out to the daily for a moment and kind of game this out. This is the high that we're talking about, $20 and basically $20, right? Right on the stick. So if we're looking for a breakout above that, we've got an ADR of 8.3%. This thing's got legs, right? So what would even half of that look like? A 4% move on the day. That would put us not quite at yesterday's high. Friday's high. That would be my target. Yesterday's high. From the close of yesterday, 19.73 to Friday's high is 4.8%. That's about half, right? So that's what we want to focus on. Half of that ADR. So for a day trade, NIO is going to be a good play. This is the perfect setup. As we come into the open, we want to see if NIO is going to fade down and tag the close. It's an institutional pivot point, and see if it finds support there, right? If we were underneath those levels, then we'd have to rally up and get through them, and then, at the open, and then get our rally up. But we're already above them. So what we want to see, as long as CPI doesn't drop this thing like a brick, we want to see either that it comes down and tags the close of yesterday, gives us that Busby and then rallies up, or that it just doesn't even come down and get to that level and just rallies up. And IO's looking pretty good. And I'm sure it's not the only one, right? Look at its peers. Its peers very likely has the same kind of charting. And if you look here on TrendSpider compared to looking at it on Thinkorswim, all we have is that green candle. Yesterday's price action. Thinkorswim doesn't show you the Globex on a daily chart. Once the market opens at 9:30, then you'll see that candle on the daily chart, but not until then. So that's why these two charts look different. We are underneath the trend line on Lee Auto, struggling to get over it this morning in the pre-market. That's a very beautiful trend line breakover. In Lee, the target would be close to $27, that 50 period moving average. I mean, I know it's a sideways 50 and we have no respect for a sideways 50, but it still gives us a clean target to aim for. The two lists at the bottom here, these lists are based on weekly options. As long as a company has weekly options, it's in the list. That doesn't mean that it's liquid enough to trade, but it has to be liquid enough to earn weeklies. And that's a good starting point. There's 600 names that have weekly options, and I can't have a watch list with 600 names, so I had to break the watch list in half. That's why there's two lists. I broke them in half literally arbitrarily. I just grabbed some names and put it on one side and then some names in the other. So the distinction between the two lists is irrelevant. What we want to focus on is, are there any opportunities in the pre-market? And as you can see, I mean, there's a lot of names that are up at least 0.5% or more. So there is plenty of opportunity. Now, we want to follow that down the rabbit hole and start asking questions. What sector do they belong to? What industry? What sub-industry? And then we use that for our opportunity. So that's what I got for you guys this morning. Be careful, be safe, and I will see you all in the chat room.